Welcome back, friends. We were discussing about the income statement. So let's continue our discussion on to the income statement. In the last discussion we are preparing a trial balance. Now, once our trial balance is prepared, which will always will be a balance, means both balance will be same. Debits will be equal to credits. That will show to us from where we are going to make the next statement, which is called income statement. Friends, before going to the income statement, we need to do another analysis of the trial balance, that we will be bifurcating two important aspects in the trial balance. What is that bifurcation? We need to do certain items which are capital in nature and certain items which are revenue in nature. What is capital? Capital is which having a long term in the organization, which will be used for the long term, and long term means more than 1 year. In accounting, we always mean long term means more than 1 year, and when we are saying short term means which are being consumed within the period of a 1 year period. So that is short term. So those are the called revenue items. So we need to differentiate which items are capital and which items are revenue in nature, because in the income statement we will be only considering revenue items. We are not going to consider the capital items. Capital items will be going to the another financial statement, which is called balance sheet. When we are saying capital items we are going to make, how capital items we are going to consider, which capital items are there. So as said, capital incomes. Let's firstly understand what are my capital incomes. So capital income which is long term in the nature. Just for example, I said any kind of investment which are being made by the owners in the company, it's a for long term, right? So if it is for the long term, so this item will not be included in the income statement. This item will go to the balance sheet. Same way, if you have been borrowing from the banks or any financial institution or from the public, so those borrowings are also not going to be there, because these are for the long term, that's more than 1 year period borrowings are there. So those borrowings are also not being going to be considered in your income statement. And other than that, any income which you are having, you are normally having income just like you earn interest or some kind of dividend. So they are routine income, they are coming every annually. So that means that's that type of income you are going to consider. You are making sales, your turnover is every year, it is continuously happening. So this will be a revenue income. So revenue incomes will be mainly, as I said, two types. One is sales, and second is any kind of receipt of dividend or any kind of interest. Now, second important aspect related to is now expenditure. Now, when we have the revenue expenditure, or what are the capital expenditure, so all long term asset which you have purchased, the asset which are having a long life more than 1 year, are going to be my capital expenditure. So I am not going to be considering them in my income statement. So in the income statement, only the revenue expenses which we are making are going to be there. So capital expenditure, I bought any asset, fixed asset or any kind of intangible asset, my goodwill of my organization, any patents we have made, all these are my assets which are being there, and they are my capital expenditure in nature, because money I have spent for long term, not for the short term. But money which I spent for the short term to running the electricity, paying the electricity bill, or any kind of paying the salaries to the employees, these all are my expenses which I am making for the day-to-day running of the business. They are revenue in the nature. So once we are able to make this distinction between revenue and capital nature of the accounts, we are very clear with that. Now all revenue item, because as I said very beginning, please remember this, friend, this is again and again I am saying that profit and loss statement or income statement is for a period. That's why we are just taking which are expenses which are revenue in nature, we are considering only them, and income which are revenue in nature, that is within a period of a year, we are going to consider, right? So when we are now going to make from this, we are going to make an income statement. Now it becomes very easy. On one side of my income statement, I am going to write all my incomes which I am making. So I said generally there are two incomes which are left with me. That's all my sales which I have made is going to be my there. One thing which you remember is whether you have made sales on cash or credit, with this will be remain with you, because this is the income to you. even if you have not received the money from the credit sales, but that is the income which is you have made, because accounting is based on double entry system which we have made. So if we are making double entry system, so we will be considering everything as a sales. And second item would be the aside any income which in the form of dividends or interest or something like that is coming, or any from selling any kind of your long term asset which you have sold, some additional profit has generated from there, that will be part of your revenue income which you have considered. Right now, from here you are going to write second side is you are going to prepare all expenses which you have done. Friends, we bifurcate here my statement into two portions. We don't do which we share with the public, but internally for our analysis we do another bifurcation in the statement. One is called trading account, other is called profit and loss account. In the trading account we write all incomes which all my sales only income which are sales, and expenses we first write only from selling the products. For selling the products means how much purchases I have made and how much purchase cost. Basically we don't write purchases, we write what is the cost of goods sold in a year. How we calculate cost of goods sold? To calculate cost of goods sold, we need to understand, first we take what was my opening balance, then I add to it my all purchases which will happen in a year, and from that I subtract my all kind of closing stock which is left with me. So that balance figure will be giving me cost of goods sold. That means that is how much goods which I have sold and what is the cost of that. And from other side I said is considering my sales. So if I subtract from sales my cost of goods sold, it gives me a figure which is called gross margin. How much gross margin I have. Now from this gross margins, which is from here we prepare the second portion of the income statement, which will be there is that we are subtracting now all other expenses which are not related to the sales of the goods, but they are marketing expenditure, my administration expenditure, all expenditure related to the salaries which we are paying to the employees. All this will be considered. After subtracting all these expenses, what left with me is the net margin. So from this total incomes we will subtract all my expenditure. If I put a journal framework is putting all my sales, my all income and subtracting all my expenditure. That will give me the figure of net profit which my organization has made in a year. So let's summarize our discussion. Our discussions are summarized in this way, that when we are preparing the profit and loss statement is for a period only, it's not for the previous year or next year's expenses will not be considered. Only expenses which are of this particular year we are going to consider them. We are not going to consider future and not past. But one important expenditure which I didn't mention, which will be coming to you, is a usage charge of the assets, because your asset which you are using over a period of time, just like you are using air condition, which is a long term asset you have purchased. For that assets we put another expenditure, we put how much is being used, that asset is being used, building or anything, how much being used in a particular year. So that is very complicated exercise, but to put in a very simple way, we say we define a rate of depreciation, how much money is being put as a depreciation expense for year. So that expense also being deducted from my total income which we have made in form of expenditure. So once you subtract that give you a figure of net profits. That figure is basically, after this you can subtract another expense which we normally say is a financing expense, that is any interest which you are going to pay for your bank loans or kind of loans which you have taken, or any kind of debentures you have issued, you are paying interest over that. That financing cost is also subtracted. So that figure is give you profit before tax. So on this profit before tax we will subtract, we will calculate the tax which we are going to pay, the tax rate. Just like now present government has a tax rate, so let's say 30%, and then on 30% you are going to pay 30% as a taxes. So plus any surcharge if being put by the government, just like 10% surcharge is there. So you subtract all that money which you are going to pay as a tax, and that will give you profit after tax figure. That profit after tax figure you can distribute among your shareholders, or you can keep some part of your profit for your future. Thank you very much, friends, for understanding income statement.